Good afternoon, ladies and gentlemen. I hope that most of you can hear well when I'm talking now. Welcome to this side webinar. I see that there's a lot bigger than normally. Just to give you a quick indication of what this webinar is about, it's something that I've been doing since the beginning of the year. It's a monthly webinar on various tax topics that would be relevant. As far as I know, it's something that's also free to site members. Okay, going to be talking about today is the ITR14 form, which is relatively new. I'll go into in more detail today. Unfortunately, there's not sufficient time to cover the whole form, and we'll field on it in detail. But we can add two aspects of the form. First, to look, just see, we can add an overview of how do you get to the form and unfold as you make certain choices. And the second part, and that's the biggest part of the presentation today, we can add what are some of the implications if you use certain options on the form. So let's say you indicated you are a certain type of business. What the implications of that be? I just think I'm going to quickly, the 30-second break, just to see that there's a lot of people on the saying that there's no sound on their side. Continue. Or can anyone, perhaps a better question to ask. Okay, I see people who can hear me, so let's continue. Then I think tricking would be available if there's some problems. Okay, that's just if you're welcome to ask questions, and there's quite a lot of people. I think you can have a question in the Q&A section. There it looks like the third tab on my screen. Unfortunately, I might get to everyone's questions in the time allocated, but I'll keep an eye on the Q&A tab and options that seem to come up regularly as we go along. I'm also more than welcome to wait till the end, so we'll have a little Q&A session at the end as well if you ask your question then. ITR14 form. The form as it stands now, the new form that came in May this year, this is basically tailored or adjusted for whatever the name of the tax-paying company would be, and the form gives you 5 options or 5 classifications of companies that you can fall into. So it would be a dormant company, and we're going to talk about each of these classifications in the next few slides. The next one would be a block company or a body corporate that's managing a sectional title. The next one would be a micro business, then a small business, and a medium to large company. Now, all of these cases, some of the companies might information that's relevant to them. So, share block company, then specific provision for that information. It could just be the extent of the amount of information that's required. So for a smaller business, obviously there would be less information required than for a large company. Also very important to note is that these classifications that the board they at this point in time, the only classifications except for the second one. Classifications are only classifications for the of the ITR14 form. So if a company is classified as a micro business for purposes of the form, it doesn't necessarily mean that that company is it's for turnover tax, where the micro business is also used. Those classifications that we've got, that's a classification for purposes of the form. If we look at the details of the different classifications, if we look at the logistics around form, The form is requested on e-filing or a SARS office. Important when you submit or return, the file no longer be accepted. You can't submit a handwritten return and submit a company tax return in the form old IT14 form. So you basically have to do it on e-filing, or the alternative would be that if you can't do it in e-filing, then you go to a SARS office with a SARS official would assist you in capturing that information on the. So that's basically two options as you can submit the form. Actually, and this is something that I've been getting quite a questions about. The form. Can you make good to it? Now, the whole procedure called the RFC procedure or the request for corrections process that you can follow is that you are allowed to make corrections to a form except in three circumstances. Now, the first one, if there's an active verification process underway, so I started asking you to some more information, and you've already made one correction to the form. That one request for correction that you've processed, or you've already submitted an IT14ST form. So that's the supplementary declaration that requires you to go and reconcile your income tax to your profit, your turnover to your output tax, your wealth to your and also your payroll to your remaining items given in your I-14 form. So if that's already happened, then you can't make a request or you can't request another correction. So if there's an active audit in process, then you can't request correction. If the audit has been completed or certain estimates have been negotiated with SARS. So in all instances, you should be able to make a correction. Now, that's frequently asked is where there's a time limit or a time period on this correction. There's no specific on things from SARS, but if one looks at the Tax Administration Act, it's a period where SARS can go and make your assessment. So the interpretation, and I've had some information from SARS on this, seems to that your time limit on making corrections would also be that same 3-year period. Then a thing that you possibly have to also bear in mind, if you just do your form or to your return, and the changes would result in you paying more tax, possibly be a risk of being subject to the estimation penalties on the corrections as well. Very little clear guidance as to whether it would be or not, and if you start making corrections subsequently, it might be something to consider whether you shouldn't, perhaps you considering the voluntary disclosure program and then they predict yourself.
No, nothing, it's a connection. Hello. Our thing is not working.
I think so. We can go on again. Yeah. Right. The ITR14 form and the different classifications. Unfortunately, these slides see that they can't move on the system that we're using to do the presentation. The first category that we're going to be looking at is dormant company classification, and specifically for purposes of this form, SARS classifies a company as a dormant company if that company did not during the year, also full year, did not carry on a trade actively. If a company carried on a trade and stopped trading during the year, then that company is not going to be classified as a dormant company. So it must be a company that didn't trade for the assessment that you're looking at. If you've got a company that falls into the dormant company classification, then it's to ask you to give certain information about the assets and liabilities, but only if that movement is more than 5 million. I'm going to ask you to give certain information about your capital gains and losses. Now, if the company didn't trade and there's been a change in assets or the liabilities, then it means that the assets have been disposed of, which would be capital gains tax. And if there's the liabilities, it could be a repayment where there shouldn't be any tax implications. And it could also be that debt was written off, in which case you'd have to start looking at the provisions of Section 19 and of 12 capital A of a schedule. So basically reduction in sections. Right, what for a company to trade? So seeing that that's what triggers a company to be classified as dormant or not. If the definition of a trade, it says it includes every profession, trade, business, employment, calling, occupation, or venture of the normal type of business activities that one would normally expect to constitute a trade. Or, and the very important one that people often don't consider to be a trade just because it's, in cases, passive income, the level of any property or use of or the grant of use of intellectual property. So if it's on a property letting business, that would also trade. But let's take the example of a company with 1 or 2 or 3 properties in it that's being rented out. The company would also be trading, so that company cannot be classified as a dormant company. Now, types of income that the company could earn are not included in this definition of a trade. And obvious ones would be interest income and dividend income. So typical passive things. So if a company only earns dividend income, the company would, in terms of classification, be classified as a dormant company, in where you form something like a holding company or an investment holding company or a holding company. That company would also fall in this category. Now look at what normal consequences of this classification would be. The first one would say that if a company doesn't carry on any trade, then there's no deduction in respect of the expenses incurred. So 11A requires that you must be incurring expenditure for purposes of a trade. In no trade, there's no deduction for the expense. There's one rule that you consider, and that's practice note 31, which says that if it's interest income that you are receiving, then you are allowed to deduct your interest expenses, but limited to the income that you've received. Important to remember, if you've got a company that's classified as a dormant company, you're able to carry forward any assessed losses. So a company with that dormant company would, the year that company doesn't pay on any trade, loss would be forfeited. Right, next classification, if you go to a share block company or body corporate, so that's a very specific type of classification. And what the legislation says there and where it might be what the aspect that you have to consider. In these companies, the legislation specifically says that any levies received by these entities would be exempt from normal income tax, and then the first 50,000 rand of other income received by these companies. So, in cases, the most difficult aspect of completing these returns for these types of companies would proceed to go and identify what are the levy income that they receive. And secondly, seeing that this company would now be incurring expenses for purposes of producing levy income that's exempt, and that 50,000 of other income that's exempt. Some difficult for these companies would be to go and portion their expenses to the deductible and whatnot. Now, if you've got clients like this, we're not going to go into any further detail, and where you might be struggling with these supports, so you should very nice interpretation note 64 that might be useful in this. Then we look at the micro business classification. Now, it would be classified as a micro business if a company has got gross income of less than $1 million. As income in this context, there's been some debate that it might mean something else on your ITR14 form, but going to look at the guide on the ITR14 form. It says that gross income here means gross income as defined. So it's basically all the types of income that meet the definition of gross income. And then if the company has got gross income of less than R1 million, the total assets of this company must also be less than R5 million. That comes up in respect to assets is market value, the book value, the carrying value, the cost of assets. What exactly should we look at to determine what to use? Now that, unfortunately, there's no clear guidance from SARS. I think the market value would be unrealistic to expect, especially something like micro business, to go and determine the market value of its assets every. So it makes sense to use the book value. And that's the value that would be available to the taxpayer. Just very important there, it's the net value of your total assets. It's the value of your net assets. So the one side of your balance sheet. So you don't look at your equity section of the balance sheet, you look at your asset section of the balance sheet. Now, seeing gross income of less than R1 million, it might also qualify for turnover tax if the company is registered as micro business tax purposes. Does not complete the ITR14 form, it must complete the tax forms. And it also be that this company is a small business corporation. ITR14 form must still be completed. I'll talk about small business corporations in more detail in the next. Right, on to the next two categories, the small businesses and medium to large businesses. We look at the distinction just now, but in a lot of these two categories very similar. It's just the medium to large businesses section information, and the small businesses as well as the medium to large businesses. You fall into this classification, you also have to submit your annual financial statements as part of the 14 form. If we look at the classifications, the classification would be we've got gross income of less than 14 million, total assets of less than 10 million. Once again, an entity that falls into this category could also be a small business corporation. That entity still needs to complete the ITR14 form. As one, a medium to large business would any company that doesn't fall into any of the above categories. It could still be a small business, as we'll see in the criteria when we look at section 12E, and they must also still complete the ITR14 form. The next that we're then going to look at would be what are the choices that you have to make, and then also perhaps more importantly, what the implications be of some of these choices if you add that on your ITR14 return. Now, unfortunately, it's not a case of being able to choose what you do or not. You have to put on what it actually is. The session would give you an indication of what the correct classification be or what would the correct choice be. And then it would also give you an indication once you've made that election or once you've made that choice or entered that information, what is the other tax consequences you have to consider. Also important, in terms of the penalty system under Section 223 of the Tax Administration Act, the penalty for different types of actions. So if you, like, for example, acted with gross negligence, then the penalty would be a lot more than when you wouldn't act with reasonable care when you completed your return. So there'd also be a few, if you make a choice and it's the wrong choice, the choice that you've made on your ITR14 form could start to affect your penalty later on if such questions what's on the form. The aspect of the ITR14 form that I would like to look at is a question where it asks, is the company a small business corporation as defined in Section 12E? So just important again, the classification of the company according to the ITR14 form doesn't determine whether it's a small business corporation or not. It could just be whether it's a small company or not. So a company is a small business corporation would depend whether you meet all of these criteria. Now, if you go through them one by one, the requirement is that in order for a company to be a small business corporation, it is a CC, so a cross corporation, a cooperative or private company. In a lot of small businesses with this requirement, the requirement is that all the members of this entity must be natural persons. So the company can only have natural person shareholders or members if it's a close corporation. Then something that's been changed with the figure, the gross income of the company must be less than 20 million. So annual gross income for this small company must be less than 20 million. They must have no other shareholding in companies. So these natural persons who are the shareholders in this company must have in other companies, other than the following list of companies. We'll go through the list now. If we think about the logic behind this for a few moments, so that there's a threshold on your income, the easiest way to gain company into two companies that could be small business corporations would obviously be if that natural person could hold 100% of company A as well as 100% of company B, and then just split the business up into those two companies. So that's why it really says that the members can shareholding in other companies. Would be listed companies or collective investment schemes. Now, these ones, specifically because it's highly likely that a small business is going to be bringing its business into a listed or collective investment scheme. Then companies contemplated in Section 10(1)(e), and Section 10(1)(e) specifically refers you to the body corporate. So basically, the company of the additional title property buying, the instant cooperatives and mutual associations, venture capital companies, then any that is never traded and where the asset of that company doesn't exceed 5,000 rand. So basically a dormant company that's never traded. And if the holder holds shares in a company cooperative or CC that has taken the steps to be traded. So where the business is going to not carry on, and all the necessary documentation has been submitted. The last two, and I think these two are slightly more complicated than the first four requirements. The first requirement that you have to meet would be that less than 20% of the receipts of this company must from investment income or from personal services. At Section or that requirement on the next slide. And the last, the company must not be a personal service provider, and we'll set the requirements for personal service providers in a few minutes' time. Okay, I see that there's a lot of questions coming up on the chat box, so unfortunately I don't think that's going to work if I have to try to answer all of those questions. Let's perhaps rather say that all that you want me to answer, I'll answer that at the end. There would be an opportunity at the end to type the questions on the chat box. I'll look at those specific questions. Okay, that not more than 20% of the income of the small business corporation must come from investment income. What is investment income? Now, income is specifically defined for purposes of Section 12E, defined as dividends, foreign dividends, royalty, rent income. So very important there. Even though rent would be paid normally, it's still considered investment income for purposes of Section 12E. So your small company with a few properties that you rent out would have a small business corporation, seeing that rental income from immovable property would be investment income. That's the only income it earns. So your shareholding companies, your companies holding intellectual property, and your companies holding property that's being rented out, they need to fall out, seeing that they're earning more than 20% of the income as investment income. Now, perhaps just a question that also often comes up when looking at small business. Can small business corporation have a subsidiary? Nothing in Section 12E that a small business corporation from a subsidiary. Where could, however, come in? So there's two things to consider here. Firstly, that subsidiary that the small business corporation got would itself, that entity, would not qualify as a small business corporation. So only a holding company would qualify as a small business corporation, seeing that the company you classify as a small business corporation can only have natural persons as the member of that company. So your holding company would qualify. The aspect to consider would then be that if the subsidiary receives dividend income from, or if the company receives dividend income from subsidiary, that dividend income could result in the holding company receiving more than 20% of its receipts from investment, form of investment income, which qualify holding company from being a small business corporation. Right. Entity receiving interest would be receiving investment income. And I think this is quite an important one. Any return that's obtained from the investment or trading of financial instruments. So you in this company, that exclude the company from being a small business corporation. And so it includes any obtained from the investment or trade in financial instruments, marketable securities, or property. So any investment or trading in immovable property, the income you get from that would also be classified as investment income. So any of these property development activities, if they're carried out in a company, 80% of your receipts comes from this property development activity. The company is also going to be disqualified from being a small business corporation. Right, personal service. So the company cannot receive more than 20% of its income from other income or from personal services. Today is got to do with the nature of the service that's being rendered. So it must be a service in the field of accounting, actuarial science, architecture, auctioneering, auditing, broadcast consulting, which, if one thinks about it, consulting is quite a broad term. Education, engineering, financial service, broking, health, information technology, journalism, law, management, real estate broking, research, sport, valuing, transition, valuation, or veterinary services, veterinary sciences rather. So the types of services that would fall into personal service, it's at this list that we've given here. It's all more traditional types of services. And in the case in to go where that was confirmed that the types of services that really intended to constitute personal service would be your professional types of services. And the reason behind that is that small business corporation regime was really intended to give a tax benefit for professional services. It was really intended to give a tax benefit for small start-up business other than professional services. That said, if you got one of these services, and very important, if that service is performed personally or by any person who holds an interest in a company, cooperative, or close corporation. So it be the person who's the member of the CC only performing the service himself, and you've got the new would have personal service, but then there's an escape provision. That is, if this company, cooperative or corporation does not throughout the year of assessment employ or more full-time employees, other than shareholder or member or its connected persons who are on a full-time basis engaged in the business of that company, cooperative or corporation in rendering that service. So this is that a personal service, if it is service in one of those fields there at the top, if it is personally performed by a shareholder or a member of that company, but it with the company doesn't involve full-time employees. So that's your way out of this, would be employing 3 or more full-time employees. Now, be very careful there. The fact 3 people employed, that really means that you render personal services. The idea would be that it says that 3 or more persons must be full-time basis engaged in the business of that company, of that service. So it might be involved in this service that's being rendered. And let's say let's take the example, you appoint a TAD, that account as one of your employees. So they have to ask, would one possibly say that the TAD is engaged in the business of that company on a full-time basis and part of doing the service? And that's a lot of interpretation for that. My view that is not really part of the person the service. So if you argue that person is actually part of all the services. For personal service, there's a question. What about admin staff? It's quite grey. I think an admin person involved in the admin of a company is to be more involved at least than someone like the lady or the gardener. So admin staff, if that is really necessary to provide the service that's being rendered, I would say admin staff counted in as one of these employees. Edges of being classified as a small business corporation, first a lower effective tax rate, so about 550,000, if I'm not mistaken. I think that amount might be slightly higher after the last tax rate. 550,000 of this company would be taxed at a lower rate than an ordinary company. Then the company would also qualify for more favorable allowances in respect of its assets. So if it's got a manufacturing asset, then it would be entitled to an immediate deduction. If it's an asset, there would be a 50-30-20 deduction. So the 3 year, that's literally way up front. And then also another benefit of being classified as a small business corporation, it's something that's on its way in the new legislation that's being proposed in shareholder loans. A small corporation would be excluded from following the shareholder loans as equity loans. So another classified as a small business corporation. That we can consider. On ITR14 form, it asks whether this company will claim any pay-as-you-earn credits into of an ITR5. Now, when a person has an ITR5 and possibilities to claim there, only if pay-as-you-earn was withheld, obviously. So we can see when could pay-as-you-earn possibly be withheld. Now, three components that you require before pay-as-you-earn can be withheld. First, it's that there must be an employee, there must be an employer, and that employer must be paying remission to the employee. Now, the definition of an employee, these are just a few of the elements of that definition of an employee. It's that a person other than a company who receives remuneration, so clear that's not the one that the ITR14 form is aimed at. That includes a labor broker. Now, in 2009, a labor broker has been defined only to a natural person. So a labor broker cannot qualify or can't be a company that, for tax purposes, can't be a company that would be claiming pay-as-you-earn credits. And that leaves us with the type of company that could possibly be claiming pay-as-you-earn credits instead of an IRP5. We're a personal service provider company. Okay, so the definition of a personal service provider company, if we start at the top of the slide, it says that there must be a company, or in this case, there is no trust, seeing that we're looking at the tax return. So the company that renders service to a client of that company, and this must be rendered by a person that's connected to the company or the trust. So in the case of a company, shareholder or the connection of the shareholder. So let's take the example of a spouse of the shareholder of the company. Okay, the first thing, if you don't have that, then you can't have a personal service provider. So the company must be rendering a service to the client, and that service must be rendered by a connected person in relation to the company. Then to the bottom of the slide, it says unless you've got 3 or more full-time employees, other shareholder or its connected persons employed throughout the year, and the wording there, if you look at the legislation, is very similar to 12E when it talks about personal service. So once again, if the service that the company renders, there is 3 or more full-time employees other than the shareholder or connected person, then you can be a personal service provider company. So that's an automatic personal service provider company. That's not the case. So this company doesn't have 3 or more full-time employees that's been employed throughout the year. Then the company or the trust would be a personal service provider. And it's important there to note that there are 3 requirements. So if you meet any one of these requirements, this company would be a personal service provider. But if the person rendering the services, so there's connected person, the company, if the person would have been an employee, had it provided service directly to the company, to the client, then the company would be deemed to be a personal service provider or to be regarded as a personal service provider. Second, if the tasks are to be performed at the client's premises or is subject to the client's supervision and control over the manner of the execution of the tasks. Secondly, you have to go and sit at premises of the client, or that is going to give you instruction as to what to do, similar to the type of instruction that an employee might get. Now, these two are very gray and actually very difficult to apply. If you need to go, if you're dealing with an issue on this, the interpretation note Interpretation Note 7 has been issued by SARS. And Interpretation Note 17, even though it deals with independent contractors, this is fairly similar to these first two requirements for personal service providers. So it's a good, useful point of difference to consider. Then, and this is the one a lot of people often the first one to consider. If more 80% of the revenue of the company or the trust comes from one person, you would have a personal service provider. So if more than 80%, I haven't found correctly, more than 80% of the revenue of the company comes from client, then the company would be a personal service provider. Someone asked about the interpretation note. It's interpretation note 17. That's the one dealing with practice. And there's also, is person working independently, or is this person can really be viewed as an employee? Okay, that's being classified as a personal service provider. First would be that the payment to employee tax, which one thinks about it, eventually you'll have to pay tax on all of your income. So that's perhaps not the worst thing in the world. Where the problem comes in is that if a company is classified as a personal service provider, Section 23K also applies, and Section 23K prohibits the deduction of that list. It allows you to deduct in the company your salary costs, provided that the salary cost is tax of the employee. It allows you to deduct your legal costs, your benefits, contributions made by the company for benefits on to, and then only a few expenses relating to your assets, if assets are wholly and exclusively used for the purposes of your trade. So almost Section 11A deductions would fall away if Section 23K applies. That's a real bit disadvantage of being classified as a personal service provider. I'm just going to go slightly quicker. I see we lost some time at the beginning when the sound problems. If we 14 form and the capital gains tax information you have to indicate there, just reminder again, there would be capital gains tax on any disposal of any asset. Your capital gain or loss would be calculated as the difference between your proceeds and your base cost. So in form, you have to put in your capital gain, so you have to record your proceeds, and that's so that you manually have to put in base costs, or a figure that you have to put in, and the capital gain amount that you record on that form. With capital gain or loss before the inclusion rate of a company, that 66.6% has been applied. The capital gain, all you get won't be an automatic calculate. The form will do it for itself. So you have to put in this your proceeds, that's your base cost, and this will be your resulting capital gain or loss. So it's not an automatic calculation. So you're going to put it in, and the importance of that would be where it is qualified for an exclusion from capital gains tax. You have to still show the proceeds, still the base cost, and then enter 0 for your capital gain. So two of the exclusions that you have to bear in mind, I've put the section order of numbers from the 8th schedule there. Just in mind, if you've just to run through it, if you make a loss on the disposal of certain shares as a result of receiving a dividend, so then that you would quite often get if the company had a share buyback, paragraph 19 quite often comes into play. Paragraph 64B, if a person disposes of shares held in a current company and that person holds more than 10%, few other requirements that must be met, you could apply for an exemption from capital gains tax on the disposal of those foreign shares. And then paragraph 65 if you've got an involuntary disposal, or paragraph 66 if you dispose an asset with intention of or replace that asset with an asset, then you get capital gains tax rollover treatment. I have the question on the side, perhaps I'm not sure, I haven't followed the whole discussion, but the question about what about paragraph 51, so the rollover, if you take your out of the company to the natural person's owning company, obviously paragraph 51A would also be clear. So this is not a complete list of all the exclusions that one can get for gains tax. This is some of the more common ones that we would find. So thanks for that question. It looks like Marika. 51A, you can also add that to the list as one of the possible exclusions. The one on capital gains tax, the question would ask you, was the company a party to a transaction subject to the corporate during the year? The company was. They need to go and put in on proposal the mechanism in which the corporate rules use would say that in a lot of cases your proceeds would be deemed to be equal to your base cost. You have to remember to go and indicate it like that on your ITR14 form. And seeing a lot of these capital rules or the corporate rules are elected to opt out of these the corporate rules, and I agree with that view that if you forget to put your proceeds being equal to the base cost on your ITR14 form, that could be viewed by us as having elected out of using the corporate rules. Certain questions about international transactions. I'm not going to go into these in a lot of detail. However, I'd like to just touch on one or two of them with often a lot of questions. First one, the company receive any foreign income, and that's would be important. Any sourced income could possibly qualify for an exemption or at least being taxed at a reduced rate in terms of a double tax agreement. So once you've clicked to say that the company did receive foreign income, then the section on double tax agreement relief would open up. There are any foreign expenses, and any royalties, interest, dividends, or consultation fees to non-residents. Now, the question there mainly relates to the withholding taxes that the company then has to adult. So as it stands at the moment, dividend to a foreigner would be subject to dividends withholding tax, so the normal dividends tax, and so paid to a foreigner should be to withholding tax. The new withholding tax on interest paid to foreigners and one that's on its way for service fees being paid to foreigners, they come into play in 2015. So then you shouldn't have a problem with withholding taxes on those ones. And withholding tax here would, in a lot of cases, be the tax that the company had to withhold. So it's not necessarily the company's income. Actually, the counterparty's income, the company had to withhold the tax on that. Okay, then, and I think this is one that's very relevant. So I would perhaps focus on it slightly longer than on some other or the other topics on the slide. That's in the form, will the company claim a foreign tax rebate in terms of Section 6 Quad? Now, the whole reasoning behind a foreign tax rebate is, if you take the example of a South African company, the South African company enters action with a customer, let's say in Zambia. So the renders a service to the customer in Zambia. As a resident, the company would be taxed on its worldwide income, and that service might actually be performed in that Zambia tax the income that's Zambian source, which would leave the South African company being taxed and also being taxed in Zambia. Now, in a lot of cases, the double tax agreement with South Africa may taxes income, but other countries could also tax the income, which necessarily resolves the issue of double tax. So the reason we've got Section 6 included in the Income Tax Act. Section 6 says is that residents' taxable income includes the following: any received or accrued to that resident from a source outside of the Republic, foreign source income, including your taxable income. There's one or two more specific items that I haven't listed here, or capital gains tax, source outside of South Africa. If you have two income streams, then file for a Section 6 quad rebate. And the block also indicates that the main factor that could entitle you to a Section 6 quad rebate would in your English foreign source. So, and I think I briefly saw from the course my eye question about where do you find the source rules. Now, the rules before the years of assessment before the 1st of January 2012, it's usually quite complicated. So there's actual source where you're going to look at case law and source was, but the legislation also contains the deemed source rule, where it says of actual source, you also add these deemed sources to it. And it became quite complicated to apply this definition. So from first or from the assessment commencing or after the 1st of January 2012, there's only an actual source. Actual source would go and look at your legislated source. So Section 9 now contains a whole set of source rules to what the source of income would be. If the specific transaction that you're looking at, if there's no legislated source rule for that, then you have to still go and look at case law. Now, important things like the income from the sale of goods or income from rendering services. Until the source there is not legislated, so you have to go back to case law, and case is you have to go and look at, especially identify what the cause of your income is. So what is the source of your income? Why are you receiving this income? And you have to go a step further and ask, but where is that source? Where is that located? So let's take an example. If you render services and you render those services to a foreign client, but the services are rendered physically from South Africa, what source of your income is the service you render? And where the place where you actually render those services, they would be in South Africa. So if you physically go abroad and go to the client and render the services, then your would be put on would be expected on that side. So the source is outside of South Africa. But if physically sits and do the work in South Africa, then the source of your service income will be South Africa. Okay, so that things on source rules. I did a seminar or a webinar for site on this, I think correctly, a month or two ago. If you want more on the source and Section 6 quad, then you would be able to get that recording somewhere. Okay, in respect to the Section 6 quad rebate, if we look at ITR14 form, what form requires you to fill in your the answer about the answer of Section 6 quad rebate calculation. And your answer would be that you can deduct 6 quad rebate would be your foreign tax that's being payable, but African tax on your foreign sourced income. So they have to apply, and you are going to do this calculation manually to include that last item, Section 6 quad rebate or ITR14 form. Something that a lot of you might have started to wonder about. If you've got a client and or if you've got a company that and the services from South Africa to a client outside South Africa, and there's still tax being withheld in that other country. South African countries unfortunately withhold the tax even though this is physically performed from South Africa. So it's only an in other country, but they withhold the tax on that. They would qualify for a Section 6 quite. So recently, from 2012, the legislation now also includes a Section 6 Quinn rebate, and specifically deals with services and this is where the source is South Africa. So where you physically sit and do the work in South Africa and for then all payments from your client, they're still being withheld. So the requirements to qualify for Section 6 Quinn would be the resident's taxable income must include an amount for services rendered. So you must receive the income because rendered the service. Service must physically be rendered from within South Africa and must be from a South African source. And I want to say you qualify for the Section 6 Quinn rebate if holding tax was imposed by another country with which South Africa has a double tax agreement, or any tax was imposed by a country where African does not have a double tax agreement. And this is if we've got a double tax agreement, South Africa, the country in all of it shouldn't be taxing the income. So it's only when tax on the left-hand side, or if your business with a country where there's no double tax agreement, then go and see should negotiate a double tax agreement or not. On the left-hand side, if there's a double tax agreement, then should go and try to enforce a double tax agreement and make sure that foreign tax is refunded. Okay, apply for Section 6 Quinn rebate. So it's your rebate for foreign taxes on services that you physically render from South Africa. You apply for the rebate, but one rebate would be limited to the South African taxes paid. Fortunately, South Africa is never going to give you more of it than the actual tax that you're paying in South Africa. Right. Important, if you to claim a Section 6 Quinn rebate, unlike Section 6 Quad, where you would go and claim rebate at the end of the year, for 6 Quinn, you'd have to submit the ITR14Webinar form within days after which the tax was withheld. Go and submit that to SARS. So if you've submitted your form, so it's not something that you can really that you qualify and then quickly go and submit your form. Right, and okay, there's a question asking claims in which year of assessment for the FTW01 form. You'll be claiming it in the year of assessment in your the income that was subject to the foreign tax. So in which that income is included in your South African taxable income. But in what year that income is included, you have to get the FTW0 form before 50 days after the tax was filed. Okay. Then and yeah, or the name comes up on the form. Has the company entered into any affected transactions? Now, an affected transaction, so your answer here is basically going to be telling SARS whether transfer pricing is a risk or not. And a transaction would be a transaction between resident and the non-resident, or in those other three relationships listed where the one person would be subject to tax in South Africa and the other one not. And or condition is different from the term between independent persons. So if the gray block as well the dark blue block on the left-hand bottom side of it now asking, and I think the question there might be phrased a bit awkward, on 14 form. They're asking is, have you entered into an affected transaction? So by saying yes, it automatically assumes if you can look at the definition of an affected transaction, you're saying that you've entered into a transaction between these connected persons, where the one is taxable, the other one not, and any more condition is already different from what persons dealing arm's length would have agreed to. So what I really wanted to ask was only that grey block, not necessarily the blue block at the bottom. So, yeah, for interpretation, hopefully the form gets sorted out and fixed. They ask what was. Seeing the affected transaction means something completely different to a transaction between and the non-resident who are connected. Just perhaps one last comment on this. If you have an affected transaction, so you've got a transaction between this taxable and non-taxable connected persons, with a term that's different from what independent persons would have agreed to, and so gets a tax benefit in South Africa from that. The first benefit must complete the ITR14 form as if the transaction was entered under an arm's length term. So basically going to adjust all your terms, including the price, to what the price would have been had the transaction taken place at an arm's length. As those of you who's worked with transfer, there's a lot more to transfer pricing. This is only really scraping the top line of whether transfer pricing is a risk or not. Information required about the financial statements. If look at firstly, this form says that it must be the information as reflected in the annual financial statements. I'll see a bit later on, a lot of this information you won't necessarily find in financial statements. Then the financial statements that this refers to, there's no need for them to have been audited. They'll only be signed off by the company's management. But if they have been audited and is a qualification, you indicate what the qualification was as well as what the tax effect of that qualification was. Then often, and I think to some extent a bit technical, the financial statements that SARS would require would not be your consolidated or your group financial statements. It would be company financial statements. Seeing each company is taxed as a separate taxpayer. Then the form requires these financial statements, or the other requires the financial statements that accompany the form to statement, a balance sheet, a tax compilation, as well as the notes. Now, you'll see on the next few slides the information that's requested in this form. That's really, it's not information required by IFRS. So what I mean, in order to and fill in your form, you'd have to keep record of information that you won't necessarily find in your financial statements. To a large extent, it's just classification of your information that you perhaps have to go and break up certain of the items, break it down into a bit more detail. Something to mention at this point is if the IT14SD form, the one to question about qualification, I'll briefly talk about that now. If IT14SD form also requires you to do a lot of reconciliations that would be close to able to do from your statements. So of this would be that you have to really have your financial statements of detail or a breakdown as to how you got to those figures in order to complete this form, the 14 form, and should 14 SD that you have to complete. That will then be required as well. Can we briefly talk about the zero field? So So the form specifically says, or the guide says, and I don't think you're able to submit the form without doing that. If such a line item in your financial statements, then you should put a 0 in there. You can't leave it open. So the form requires you to put a 0 in there. I think the 0 in there, it shows that you've applied your mind as to whether there should be an amount in that field or not. So when we start looking at something like penalties, if you put in a 0 there and it turns out that there was something there, it becomes difficult to try to convince us that that was not urgent. There was a question, the question about what qualification means. I think qualification would mean it's not clarified anywhere, but I think it should have the ordinary meaning of qualification to an audit report. So, not emphasis, but it says the audit agree with what's in this report or in the financial statement, except for the following that's not correct. Another interesting question there: if your financial statements are independently reviewed, not audited, possibly count as a qualification if they are on your independent review. If the form only talks about an audit, I think an audit and an independent review should work in a very similar manner. This one takes into account what they're trying to achieve with this question. We're going to look at, and you'll see I've indicated certain of the lines in red, lines in orange, and then of them in either green or black. So red line would mean that there's a big risk to have to consider if you put this information on your ITR14 form. Orange one would mean you have to at least go and think, because you might be there might be more to than you initialize. And the green or the black ones would mean that you should be fine. There's not many strange things from a tax perspective there. If you've got a long-term loan, the interest-free to a connected person, that's an asset, so to a local connected person. So basically, a long-term loan from a company to a connected person, that interest. Now, and I'm sure a lot of you have had to deal with on this, would be that there's a dividend tax risk. So we're going to look at the dividend tax, specifically the deemed dividend rules on the next slide. The other items there, your long-term loans that are interest-free to non-connected persons, either locally or foreign. Question, I've put those two in. See, you have to go and consider, why is this company willing to advance a long-term loan to a non-connected person without charging interest to it on it? So in some ways, that transaction wouldn't make commercially sense, and then you perhaps have to ask a bit more questions once you've established the reason why there's no interest on a non-connected transaction. Right, at the deemed dividend rules on debit loans, Section 4E of the dividend tax regime says that a company that advances a debt, so taking a loan, to a person other than a company, so deemed dividend under the dividend tax system, would risk on a company to a company loan. So it be a loan to a person other than a company that is a resident, it must be a local loan, and that person must be connected in relation to the company, or must be a loan to this person's connected person. When would the person be connected in relation to the company? So if a natural person would be connected, or any person other than another company, that's the person we're looking at here. Would connected to a company, each person holds 20% or more shares of the company, or a person connected to such a connected person. Then, once you've got that, so in most cases, it's a company making a loan to a natural person to a trust. You have paid the dividend if the loan was advanced by virtue of the shareholding. So the reason for advancing the loan was the fact that the person holds in the company. They might have to deem dividend on that debit loan. If the loan is something else, so let's take as example the fact that the person is also employed by the company, so we could picture of the person being a director, then you're not looking at the deemed dividend, they might be looking at the fringe benefit. So also bear in mind that if you say that the amount is not deemed dividend because it's advanced by virtue of shareholding, you might be opening up another tax consequence there. Important deemed dividend rule under dividend tax is aligned from what it used to be under STC, and this says usually while this loan is outstanding, you're going to have a deemed dividend which is equal to the greater of just at the official rate, and behind here the rate refers to the rate plus 1%, my actual interest, or so not be the case if you charge more interest than really saying here while this loan is outstanding, you're going to have a deemed dividend of another amount of the interest you should have charged at the official rate, but that didn't charge. So if it was outstanding for the next 20 years, then they have a deemed dividend every year. And this is a deemed dividend in specie, so it's going to be the liability of the company to go and pay the dividend tax. So all of this came from was the long-term interest-free loan to a connected person. Then on long-term interest-free loans to a connected person, as we already saw, the deal would only be triggered by an interest-free loan or a low-interest loan to a connected person, loan to an interest-bearing loan to a connected foreign person. So I indicated there at the bottom that both of these loans, loan that goes from a company to a connected person, could transfer pricing risk on it if that bears sufficient interest. So you should be able, in this case, to prove to SARS that they charge an arm's length interest on loan. Otherwise, a transfer pricing adjustment might be required. Then the next long loans that interest being to connected persons. And why is that also in red? Now, this fee loan would be against tax risk. And in loan to a connected person could also dividend tax risk. So to go back to the previous slide, bottom, if you have the official rate, still your actual interest paid, even though it was an interest being loan, you might be sitting with a deemed dividend. Then in green, they shouldn't be a big risk. Your loans that are interest bearing non-connected persons, either or foreign. Then to the income statement, the form requires you to give your interest to the from financial institutions, interest from connected persons, and interest from non-connected persons. The one that I have to think carefully about would be that middle one, the interest from connected persons. So just as a check to go and do, if your interest from connected persons divide by your total connected person loans, especially the local ones, if you less than the official rate, that's a problem for dividend tax. Other assets, I'm just going to go briefly through them. They or slightly less complicated than the loans. If you've got entry that was written down, just bear in mind there's good questions about that inventory right off. We have to start proving that that inventory was actually obsolete or damaged. The sale provision for doubtful debts, it's included in the slide, but I think the time is going to catch us. So just in mind, section 11J is action where the commissioner can allow funds, but on the amount that is well in the petitioner. So you'll be able to prove to us this is your list of doubtful debts, the dates included in here, and that's why each of these would be doubtful. So really loan by loan or debtor by debtor calculation. You might, in some cases, group certain debtors together, but if you just take your debtors book down and say that that's your doubtful debt problem with your Section 11 today. Any payments, just bear in mind, if you've paid expenditure in advance, you might have a situation where the expenditure would only be deductible in future under Section 28H. And short-term investments, so if you have an investment that was made, I indicated it as a short-term investment, then include if you dispose of that investment. So say you've got shares or investment in shares, those shares, if you were to sell them, it's likely that the proceeds would be included in income. I don't include there, then to explain why it wasn't income. Capital and your reserves. Now, there's a lot to say, and I think that's a completely different topic on its own. That I would like to mention is that if you are seeing that there's a movement in your reserves, so either your share capital or your share or retained earnings, consider whether you've got dividend or possibly something that could be a return of capital. And those would have certain tax consequences both for the company and for the holders of the company. There's the information on the liability side. Now that would be all of these interest-free loans on the liability side. Now the first two, the connected person loans to all that where you've got amounts from connected persons and they're interest-free. The pricing risk, and in all you not, seeing that it's interest, there's no excessive deduction of interest on the South African side. So those two would give you a transfer pricing risk. However, if you look at the first four, so your interest-free loans, either from connected persons or from non-connected persons, well, in there, you have to start thinking about the principles of the Brumeria case. So, just to give you a quick indication of what this Brumeria case said, the judgment boiled down to it that the benefit of being able to borrow money without paying interest would constitute an amount, and if it sees that it's got a commercial value, that amount could possibly be included in gross income. So you're going to ask yourself the question from a tax perspective: what did this company have to do to earn the benefit of loan? And if you have to do something to earn this benefit, it very well end up with a situation where an interest benefit could be in the hands of the company. Long-term loans, the interest being to connected persons as well as non-connected persons, always just check that your interest actually qualifies for a deduction there. As an example, if you spend this loan to acquire shares, then you'd not be entitled to your deduction, seeing that the shares would produce exempt dividend income. On the foreign side, the other issue to consider, the whole issue of thin capitalization and transfer pricing. So aren't you perhaps paying too much interest on this? And then it could just go and see that your interest that you can deduct in some way talks to your loans on your balance sheet. And speaking out in this case to identify that whether that you deduct might be excessive or not. The next slide, so the current assets there at the top. The form asks you is to give your gross trade creditors and the amounts payable that are not older than 3 years. So all of your that are not older than 3 years, those are a problem. Now, all of the next few ones should have actually been either in red or in orange. If those trade creditors that are older than 3 years. So there is a mistake there. It should be older than 3 years. If then you're looking at the issue of possibly might have already prescribed, and it is prescribed. So let's take the example, you bought trading stock from the creditor. The creditor allows this debt to prescribe. Then you end up in a situation where there's an improvement of the cost of that trading stock that you previously deducted. Okay, so debts older than 3 years come in. If provisions that you put in there would generally not be deductible. If in any the advance payment amount, just think twice whether that amount should it perhaps be included in your income already. So seeing that you taxed on at earlier of receipt oil, so the receipt might have taken place even though the accrual might not yet have taken place. You've got the shareholder for dividends or proposed dividends, then see that your dividend tax is already payable. Income statement, the terms that are highlighted in orange there are the purchase and the sales to connected persons. This would be a risk from a transfer pricing perspective. The income items. If a company receives admin, secretarial, rental, guarantee fees, or any other fees from a local connected person, that itself isn't necessarily a bad thing. So I have to ask a second question about this, to ask, did this company actually render these services that it's being paid for to the local connected person? Now, if an artificial arrangement where the income is just being used to move profits from one company to another company, they might be looking at a tax avoidance arrangement there. So for these types of fees received from connected foreign persons, there you're looking at a transfer price issue, in particular if you don't charge that connected person enough. Expenses side, once the admin, secretarial, rental, guarantee fees, and other services that were paid for to a connected local person, the question again would be, did they actually receive something from this connected person, or did they just make the payment? If you just make the payment without having actually received the service from them, your audit might be. So connected persons in South Africa, if these fees are paid to them, then you're looking at the same as above, but also transfer pricing risk. Problems here, any actions or improvements where repairs and maintenance are excluded to your audits that went through the income statement, but that, then the question you're more than likely going to be asked by SARS would be movements or the costs that you capitalize there, where it's not perhaps from a capital nature and therefore not deductible. And it seems like this is something that SARS is asking more and more questions about, insulting, legal or other professional fees that you paid. And in the cases, if these fees relate to a one-off transaction, then you might be looking at the risk that this could also be viewed as a capital, as being so. If it's asked or if it's paid to on a restructuring, as an example, I think there might be a good argument there, but that's of a capital nature. Then, strangely enough, similar for BE costs. So in some cases, if you set up your structure, they might be to earn BE points in share. They might be possibly looking at the cost of a capital nature. If it's something like your corporate social investment costs that you have to incur every year, then there's little doubt that that should be deductible in terms of Section 11A. Tax calculation adjustments, I think this was something that I did on the PowerPoint presentation for sake. You're more welcome to look at that, and if there's questions, unfortunately, seeing that we've already reached the time for the end of the presentation, I'm not going to go through these in detail. And then the last bit that I would just like to quickly talk about, and running over the time, is the question on the form would ask, does the company have any reportable arrangements? So that I often get asked is, what reportable arrangements do you have to report? Now, the first one would be arrangement that's specifically listed by the commissioner, and you can find the notice on SARS's website where it lists these items. Now, in a lot of cases, the two main ones would be you've got hybrid instruments, period of 10 years as opposed to the 3 years in the legislation, and any of the following actions, arrangements, where there could be a tax benefit for the doing this ITR14 form. So any arrangement, interest calculation depends on the tax assumptions. So basically, how interest you're paying is going to depend on how much tax you pay, and what profit you got left after you've. So the risk here from a SARS perspective, that using interest to strip all the profits out of the company into an entity where it could possibly again not be taxed. But on that point, what would this off-reportable arrangement be? The answer would be that this is one of the tools that SARS can use to identify something that could avoidance. We then consider, do they want to apply the general anti-avoidance rules or not? Then on any transaction, if there's a tax benefit for someone, the characteristics of round-trip financing, a tax roll, or an accommodating person, so a person where a person is part of the transaction but doesn't get the consequences and all the real profit for that person, elements cancelling each other out, and that results in a deduction for tax purposes, but not counting. So you're claiming a deduction for tax, there's no expense for accounting. It results in revenue for accounting purposes, but not gross income for tax purposes. Transaction where there's no reasonable expectation of a pre-tax profit, then you have to go and ask yourself, but why did I really do this transaction? And lastly, any transaction with the present value of the tax benefit, we need the present value of any pre-tax profits that you could reasonably expect to make from this transaction. Okay, the exclusions. Now, the three exclusions I want to talk about here, so even though these transactions might fall into the reportable arrangement, it would be plain vanilla loan and the lease. So leases and loans could, in a lot of cases, fall into the, but if there's nothing structured about their terms, then these things you'd have to report every loan and every lease. Also, notice number 384 that was issued by SARS, and that notice says you don't have to report an arrangement if the value of the tax benefit is than R1. So they're looking at that would give you a big tax benefit before you go and report it. If there's a promoter, so the person who came up with this arrangement or this scheme, the person is primarily able to report it. If the promoter has not reported it, or if there is no promoter, then all participants must report the arrangement to SARS, and must be done within 45 days after the first amount was received or approved. This reporting still takes place on a different form. You just indicate whether this ITR14 return permitting contains any information on a transaction that was reported. And then report with a detailed description of the arrangement, so all the features, all the steps of the transaction. You must give a description of all your tax benefits add a description of the details of the participants. So basically going to be telling SARS everything that there is to tell about this arrangement that you've got. Okay, what if it is not reported? So what's going to happen to if participants or the promoter doesn't report it? Firstly, important to see that it's not a criminal offense. So it's just something that's going to be subject to an administrative penalty, and that you're going to incur would be a penalty per month. So for a month that you report the arrangement, a maximum of 12 months, the person is going to be liable for a penalty of 100,000 rand per month, the participant for a penalty of 50,000 rand per month. If the tax is 5 million rand, the amount doubles, so it becomes 50,000 for the promoter and 100,000 for the and if benefit is greater than 10 million, it becomes 200 for the promoter and 150 for the participant. It could become quite an expensive exercise, but some people are saying that if you get a benefit much greater than this, then you'll be willing to take the risk on it. Okay, and at the end of the presentation, there's my contact details. And to open the floor questions, I just want to quickly have a look at the chat. So I just want all questions on screen. Okay. Since the start of the session, it seemed like quite a few discussions going on. So I'm going to go back into the details of that. It's with a question from Linda that's on the screen at the moment. Linda asked the no, I think it's for question. Okay, so wait for the next question and then I'll answer. Perhaps there's something while you're thinking of questions and comments. Want to see that there's quite a few people who were in fact happy with the presentation. So I think at least it looks like some of the people, some did work. Then there's a webinar like this every, and so just keep an eye on the email out from site about webinars. And once there's a different topic, so you're more than welcome. If there's a topic that you want to suggest, you can send email to me with the topic, and then I'll try to work it into one of the monthly webinars. Someone's question about debts, Yvonne. Is the allowance for doubtful debts an automatic 25% deduction of doubtful debts listed with discretion for the commission? Is the question the doubtful debts list? Unfortunately, it's not. I just want to quickly go back to the wording. It's one slide that we didn't have time to look at. If we're at the wording of Section 11J, Section 11J specifically says that the doubtful debts deduction that you can get is an allowance as may be made each year by the commissioner in respect of so much of the debt due to the taxpayer as the commissioner considers to be doubtful, provided that the debt would be deductible has come back. Now, SARS apply this, they practice to take your doubtful debts list and allow 25% of that, but in cases where they now prevents them from questioning your list. So list, before you can really put something onto your doubtful debts list. So the 25% doesn't come from the legislation. It's from it's a note or that was issued by SARS a very long time ago, and that's still being followed. But the legislation says as the commissioner considers to be doubtful. So So you have to really be able to prove to the commissioner that that item included in doubtful debt list is really doubtful. Now, you do a similar exercise to what you're required to do for IFRS. So it requires you to go and first identify significant individual debts that are doubtful. Let's say you've got a client who you know would be going into liquidation. That client could be viewed as doubtful, so you can easily justify that one being on the list. And from on, you have to go in a way group clients or customers to be able to justify that client is doubtful, even if it's based on your historical evidence for the specific amount that you've. So the answer to Yvonne's question is automatic 25%. So you have to really be prepared to answer questions for research as to why these amounts on your doubtful debts list are doubtful or not. Then the Dorothy, very relevant and a very good question. She asks if you can't recon the SD14 form, so I think it's the IT14 SD form. There's a big explain the reason that the SD form cannot be reconned. I think it was perhaps more statement than a question. Quite see the question that relates to, but yeah, Dorothy, just to pick up on that, yeah, those of you who try to recon the SD14 form, it's not so. I think it's something that depends on each company. That form is either in some cases extremely easy to complete, but in some cases it could take you to complete that form. And that thing, and I think there's a lot of in the market or ask for something, a request for something like this. We need to have a tax calculator, so something like a tax template, then use normal tax to make sure that you've got all your normal income tax, to make sure that you've got all the line items to read the SD14 form. So it's so time consuming when you find a shortcut or easier way to do the form. Our question was, what if you can't get it to recon, or the comment related to what if you can't get this thing to reconcile? Now, quite difficult. So let's take the example. You've got your revenue, let's say 5 million. Now your profit tax 3 million. So there are 10 million difference. I think should mean that, and you can explain why that difference should be there. You've declared too little revenue on your income tax side. So depending on what direction the difference goes, if it's a significant difference, you must be looking at a lot of extra tax. Difficult explaining work to be done to SARS. I think I've missed a few questions again. Okay, then from Joan, and it's a very good question. A loan to a connected person, and is the interest calculated on the balance of the loan at year end? It should be done. If you look at the legislation, there's nothing that says you just take the closing balance. The closing balance could to some extent be easy to manipulate. So in practice, the way I've seen it done to date would be that person would take the closing balance and apply that to say that that's your loan for the year. I think the technically correct way would however be to look at your balance for the year And so your average balance for the year and apply the rate to that. But from a practical perspective, one of my colleagues raised it at university, and I'm still not sure that there is a practical answer to this. Is balance at the end of the year of that loan. So the loan outstanding at the end of the year, in these smaller companies, the company really know what that loan is, seeing that that's going to be the balancing amount once the financials have been completed. From perspective, however, your deemed dividend instead of accrued at the end of the year, your dividend tax then becomes payable the month after that. So you might end up, if you don't keep a record of what your debit loan is, you might be being liable for the dividend tax plus the interest on the period that you took to determine what of the debit loan could be. I'm not sure if there's any practical suggestions to this, and other than to keep proper record of your debit loan. Okay, Mara, can you receive the links earlier? I think, Mara, normally the links would go out earlier. As far as I understood from site, there's a bit of a technical problem with the IT systems at the end of the week, and the links only went out now. So the invites would normally go out a week or two before the webinar, and so the links then at that time. Is asking the average loan, would it be the opening loan plus the closing loan divided by 2? Is that acceptable? I'll say, I think once again, unfortunately, that might be quite easy to manipulate. So technically correct answer would, at least if one's on a month-by-month basis, that's probably going to give you a much better answer to all of this. But from an auditing perspective, probably the opening plus the closing balance would be using. But other information would really be available to them, unless I ask you for your PBs or your accounts rather. A question, but it looks like the answer. I'm asking, can you qualify for Section 6 Section 6 Quinn based on the 50/50 source? So I assume what you're asking is, let's take the example, if the services part from South Africa, partly from the South African source should then qualify for the Section 6 Quinn rate. The portion that relates to services rendered out of South Africa should qualify for the Section 6 Quinn rebate. Just once you start doing the detailed calculations, there's quite differences between these. So Section 6 Quinn, for example, apply to all your foreign taxes and unsourced income aggregated together. Section 6 Quinn works on an income for income basis. So you're in principle, you should be able to split it up. But I just want to go back up to your question, but quite different. In a lot of ways, they are quite different from each other, even though they seem fairly similar. Slow is asking, the development incentive claim is still done on the IT14 of the web for a while. Nicholas, we didn't talk about the claims or the allowances. And so if you just claim your allowance without the minister's approval for the specific project, that will be on the IT form. That would be one of your allowances that you can claim there. If you go and apply for to them to get that approval for the additional 50% of your operating R&D cost. That is a completely different form. So, and as far as I know, you will find that form on the Department of Science and Technology's website. Quite valid. So that when a company renders a service and the company has one employee who's also the director, who's a connected person, company is not rendering the service under the direct supervision of the client, and does not render the service at the premises, and the company does not receive more than 80% of the company be a personal service provider. You can come to say that the company pays director's remuneration and the deduction from the director's remuneration is financially viable to have PIE. The invoice amount by the client is viable to have PIE deducted from invoice amount from the client as well as from the remuneration again. If they provide a declaration to the client to deduct the PIE with my interpretation. If I understand your question correctly, you're basically asking if the way in which this company can then not be classified as a personal service provider company. So it's worthwhile to look at the specific facts and circumstances of this case that you had. You say here that only has one employee. It's not services under the direct supervision of the client. The client does not render the services at the client's premises and does receive more than 80% of the income from one client. So then, why would the company be as a personal service provider in the first place? So back to the specific slide on personal service providers, it says you must have a company that services to a client. The service must be rendered by a connected person, and you need at least one of those three criteria. So on the information I've got on my screen here, you won't need any of those three red blocks, which mean that this company that you're looking at in the personal service provider. During session wasn't that then. You to answer your question. Missed quite a few questions again in the meeting. People asking for C12E question on the true or false. So just quickly go back to that relevant slide that you can have a look at. Call it at this point, Justin. Unfortunately, stop the session at some point. So everyone for listening, and look out for the emails from site if there's monthly emails. Thank you.